The stock market can seem overwhelming at first, but understanding its basics is essential for anyone looking to invest or just learn about how the economy functions. At its core, the stock market is a place where buyers and sellers trade ownership of companies through shares of stock. When you buy a stock, you're purchasing a small piece of a company, and as the company grows or loses value, so does the value of your shares. Stocks are typically bought and sold on stock exchanges, like the New York Stock Exchange, NYSE, or NASDAQ, through brokers who facilitate these transactions. Investors buy stocks hoping that the company will perform well, leading to an increase in stock prices, allowing them to sell their shares for a profit. There are two main types of stocks: common stock and preferred stock. Common stock gives you voting rights in the company and a chance to earn dividends, payments made by the company to its shareholders from profits. Preferred stock, on the other hand, typically does not offer voting rights, but may provide more consistent dividends and priority if the company goes bankrupt. One of the key concepts to understand when trading stocks is the idea of supply and demand. When more people want to buy a stock, its price goes up, and when more people want to sell, the price drops. Another crucial element of the stock market is diversification, which involves spreading your investments across different sectors, industries, or asset classes to reduce risk. Instead of putting all your money into one stock, a diversified portfolio can protect you from the volatility of individual stocks. This is why many investors use index funds or mutual funds, which pool money from multiple investors to buy a broad range of stocks or bonds. Investors can profit in two main ways: capital gains and dividends. Capital gains occur when you sell a stock for a higher price than you paid, while dividends provide a regular income stream for shareholders. However, it's important to remember that the stock market can be volatile, meaning stock prices can fluctuate wildly in short periods of time due to factors like company performance, economic conditions, and global events. Beginners should understand that while investing in stocks offers the potential for high returns, it also comes with risk, especially if you don't have a solid understanding of how the market works. One of the best ways to start is by educating yourself, researching companies, and practicing with virtual trading platforms that let you simulate stock market transactions without using real money. Over time, as you gain experience, you'll develop an understanding of market trends, the importance of timing, and how to manage risk effectively. It's also helpful to have a long-term perspective, as the stock market generally tends to grow over time, despite short-term ups and downs. Starting with small investments and increasing them as you learn is a prudent approach. Lastly, it's important to avoid getting swayed by emotions. The market can be unpredictable, and even experienced investors face periods of decline, so patience and discipline are key for success. By following these basic principles, beginners can start to build a foundation for navigating the stock market, ultimately growing their wealth over time.